You finally do the responsible thing. You transfer $100 here, $200 there, building up a solid balance in your savings account. But then you check the app, then do the math. That $10,000 is earning 0.5% in interest, meaning after 12 months of discipline, you've made $50. Meanwhile, you hear about the accelerated, compounding wealth built by stock market investors, and you start to wonder if you're doing something wrong. The issue is that saving and investing perform two completely different jobs. A savings account is designed purely to protect your money. An investment account is designed to grow it. This chart shows exactly how those jobs play out over time. If you leave $10,000 in a savings account, earning a typical 1%, after 20 years you have about $12,200. But if that same money is invested in the stock market, which historically returns around 10% annually, that 20-year timeline yields nearly $67,000. The math makes the reality clear. The widest gap in wealth building is between people who save and people who invest. Choosing to keep all your cash on the sidelines guarantees a loss of potential wealth over time. Step 1 is building a foundation so you never have to interrupt that growth. Before buying any investments, calculate 3 to 6 months of baseline living expenses and lock that cash away in a standard savings account. This cash shield absorbs the shock of a job loss, a medical emergency, or a sudden car repair. With this buffer in place, you prevent the number one mistake new investors make, selling off their portfolio in a panic to cover a surprise bill. Step 2 is establishing a strict mental division of your finances. Think of your emergency fund as bucket 1, safety money. This money sits completely still and is never exposed to market risk. Everything else goes into bucket 2, growth money. The value of this bucket will fluctuate, and those temporary dips are a normal, required feature for long-term expansion. Keeping all your wealth in savings is exactly like storing seeds in a glass jar. You protect them perfectly, but nothing ever grows. Investing is taking those seeds out of the jar and burying them in soil. At first, it looks messy and chaotic, but exposing those seeds to the elements is the only way to trigger actual growth. By fully accepting this separation, knowing your safety money is secure in the jar while your growth money does the work in the dirt, you can confidently ride out market volatility without the urge to intervene. Step 3 is setting up the actual mechanism. Open a beginner-friendly brokerage account and transfer a small, low-stress amount of cash, like $50. You do not need thousands of dollars to begin. Right now, the profit doesn't matter. The immediate goal is simply building the physical habit of moving money into your growth bucket. Step 4 is making your first purchase. This is where you ignore day trading, individual stock picking, and crypto speculation, and instead purchase a broad market index fund. An index fund works by letting you buy a tiny, diversified fraction of hundreds of major companies simultaneously. Instead of trying to guess which single company will succeed, you own a slice of the entire market with one click. This method is highly reliable. Low-cost index funds are the exact strategy repeatedly recommended for most investors by financial titans like Warren Buffett. The mechanics are straightforward. You search for the index fund ticker symbol, enter your $50 order amount, and click Buy. By selecting a simple index fund over speculative trading, you immediately bypass the complicated, high-risk gambling that usually ruins novice investors. Step 5 is putting this entire system on autopilot. Setting up an automatic monthly transfer guarantees consistency, which is the actual engine of wealth generation. This chart visualizes the mathematics of compounding. If you automate a $300 monthly investment at an 8% return, after 25 years, you'd have nearly $285,000. Out of that total, your contributions are only $90,000. The remaining $195,000 is pure growth. But what happens when the market crashes? Look at the trough. Your automated system continues to deposit $300 right at the bottom. Because prices have fallen, your fixed monthly deposit automatically buys a higher number of shares at a steep discount. Setting your portfolio on autopilot removes human emotion from the equation entirely. You can stop reacting to terrifying headlines, and market crashes simply become a mechanical advantage that boosts your long-term returns when prices recover. If you have separated your safety and growth buckets, automated your deposits, and purchased a broad index fund, your transition is complete. You have officially crossed the threshold from saver to investor. The rule for surviving in this new stage is simple. You must train yourself to think in decades. You can completely ignore the random daily fluctuations on your portfolio app. Your safety money acts as the anchor, protecting your present stability. Your growth money is the engine buying your future freedom. Let me know in the comments below if you are currently in the saving stage or if you've already started investing. And make sure to hit subscribe for more actionable, step-by-step financial frameworks.